discussion on the next set of topics. So first up, AI in banking and finance is what we're looking to cover now. We're talking about Malaysian consumers who are willing to allow banks to share data for open banking-based services, but privacy objection must be overcome to wide adoption. New research from Unisys Corporation into Malaysian banking industry revealed that domestic consumers are willing to embrace new bank services based on emerging technologies such as AI and machine learning. Studies show that Malaysian bank customers have now had a good, strong appetite for tech innovations and enable digital bank services depending on the type of transactions. It is said that 52% of the Malaysian consumers are comfortable with their bank algorithms to enable online transactions where AI plays a major role in the process. Well, this panel discussion is going to be all about how AI is shaping up in the banking and finance industry. I request the audience to please use the Q&A section to post your questions. It will be picked up and answered by the speaker if the time allows. How AI is shaping up the banking and finance industry. In this panel discussion, we're looking at understanding on AI's integral role in detecting fraud, advanced anti-money laundering pattern recognition, better customer behavioral pattern, how AI will deliver on the promise of personalization, deep diving into AI's role in insurance, and the future of artificial intelligence and asset management. So while we have with us this entire panel discussion, first up, we've got Sekar Jaganathan, who's a Director, Digital Strategy, Kenanga Investment Bank, Malaysia. Well, Dr. Sekar is an experienced professional in digital business development and transformation with a demonstrated history of working in the investment banking industry. Skilled in banking, securities, equities, capital markets, and anti-money laundering as well. He's an honorary advisor for the Center of Excellence in Artificial Intelligence, expert speaker on digital business development and transformational initiatives, author of Making Miracles for the Self, Inspiring You to Live Right. We're also joined by Jayant Kumar, the founder of PayOK Indonesia. Well, Jayant has collaborated with Shape Labs in Stanford to build 20 small robots called Zooids, worked to develop machine learning algorithms that help industrial robotics to navigate in a work environment. He used image processing technique to categorize patterns in an image as moving object to avoid collision in real time using big data. Well, this panel discussion is going to be moderated by James Ward, AI advisor, Epistemology, Australia. Well, James is the founder and managing director of Epistemology, a strategic consulting and technology company based in Sydney, Australia, that is revolutionizing the way we use artificial intelligence to deal with decision-making, prediction, complexity, uncertainty, and competition. He consults to investors, financial institutions, enterprises, governments, policymakers, medical researchers, and to some of the world's leading global think tanks. Well, James is a frequent keynote speaker and a panelist at international conferences on diverse range of topics catering on the primary theme of how we can harness great intelligence to consciously create a better future. So, well, with this, I'm leaving it to my esteemed panel. Over to you, James, to take it forward.
Thank you very much for the introduction. And so what we have the opportunity to do over the next 30 minutes is to have a conversation between an AI guy, an institutional investing guy, and a startup entrepreneur. So I think that we can all bring some interesting perspectives to the question of how AI is impacting banking and finance markets. And so to kind of set the scene a little, I'd first try and decide how we're going to define banking and finance. And I think really it's the topic of money, how it's created and how it's used to generate wealth in economies. And so if we have a look at money over the last, 100 years or so and look at its track record, we'll see some interesting things. We've got, the world's global reserve currency being devalued by 96%. We've got debt. If we checked in on that, global debt 2 years ago was about $180 trillion. It recently passed the $250 trillion mark. And then we've got global GDP to debt ratios of 300% now. And so if we have a look at sort of how things are transitioning, you'll certainly see we're headed into an interesting environment and interesting times. And I think it's our role as professionals in the banking and financial services industry to somehow manage all the complexity that all of these changes in the monetary environment are driving, and make sure that we end up on the side of good rather than on the side of bad. If we go on the side of good, then we get economic development, we get growth, we get wealth creation. And if we end up on the side of bad, we get crashed economies and we get hyperinflation and we get poverty. And, hopefully AI has a strong role to play in steering us in the right direction. So I thought the way we would manage this discussion is we would first try to call out what we see as the largest dynamics in play in banking and finance today, or in the world today. And then of course that means within banking and finance, which I see as a major driver of events around the globe today. Call out what the most important challenges are, and then look at policy responses. So government policy responses, institutional responses, and then what we can do as individual investors or as bank retail customers. So, and then we'll talk about the role of AI in shaping those responses, and then the challenges of implementation. And when we do that, I'm hoping we'll get down into some of the nitty-gritty detail so that we're not only providing an overview of the space, but we're also able to talk about some of the more detailed algorithms and technologies and outcomes, investment return expectations, and so on, that can drive and shape our expectations of the next 12 months. And so could I start with you, Dr. Sekar, and ask you to, first of all, provide an overview of what you see are the primary global shifts that are happening in the world economy today, and what challenges these create at the government level, the institutional level, and the personal level.
Okay, thank you very much, James and Bhavana, for the introduction earlier. So I think the biggest change shift is now banking, the challenge of banking to do customer engagement for the unbanked customers and retaining customers because of the emergence of new fintechs who have gone to do two things. One is creating a much more simpler payment gateway, and also creating a new concept of wealth creation or wealth management concepts, right? So these are two traditional revenue streams that the banks used to own, and now people don't need that anymore because you have mobile wallets, you have payment gateways which are attached to it and everything. So I don't need the traditional current account, savings account kind of thing. And that's the biggest threat. And the second part of it is wealth creation, the other part of where banks make money for their customers and for themselves. Even that has been taken over by non-banks, right? And they are reaching out to unbanked customers as well. So these are the two biggest challenges that the banks or financial services are having to go through now, and it will continue to grow, and the impact will be greater in the coming years also. However, policy is still seeing banks as the traditional brick and mortar bank, and keeping that governance to risk management of customers' money, value, wealth creation, and having different policy frameworks for different product engagement. Insurance has a different policy, asset management has a different policy and regulation, equity investment has a different policy and regulation, and it goes on non-stop, right? So even deposit taking has a different policy and regulation. So they are very much siloed by product, and governance is very restricted, and you cannot co-mingle unless you have a license that you can do everything. So policymakers need to now evolve into the new way of new business model. That means it's about wealth creation for customer, and it is also about ease of use of cashless money, right? And these two are something that the policymakers have not made it easy for banks to adopt in a quicker way. The banks can do, but it is a very tedious process compared to a non-bank, which could do it overnight or within a much more shorter time frame.
Okay, so you see the important issues are extending banking services to the unbanked or underbanked.
Yes.
And then the role of banks to facilitate wealth creation, and
Yes.
presumably for all the people who are newly able to access banking services. Is there a comment that you would like to make in that context about the rise of, for want of a better word, let's call it Robin Hood trading? So you're familiar with just for people on the call, maybe I'll just explain what that means. It means providing the ability for anybody to trade stock, shares, equities, bonds from their mobile phone without charging any trading commission. And it's become very popular, and people who weren't traditionally movers and buyers and traders in the markets have suddenly flooded into the market, and there's a lot of new millennials who are taking advantage of this. People who never would have been in the markets before are now putting their money into the stock market. So how would you describe this as a new development, and what prospects do you think do you see for the millennials and new traders entering that system?
Well, that's a very good question. So people like Robin Hood and likes, what they have done is they have captured the millennial markets by telling them that we are not selling you wealth creation, we are selling you profitability, right? And when we sell you profitability, when we are giving you the opportunity to grow your wealth, and what we are doing is we don't want any transaction fee to do that for you. We should be able to manage that ourselves and not charge you for making profits for you, right? And that's the concept. It means the new millennials love it that you're making money for them, but they don't like it when you're making money out of them, right? So so that's the driver that's moving millennials into that. So they think that you are doing the ethical way of doing trading, and that actually builds trust for millennials. So trust is one of the key components for customer engagement, and I mean, together with the customer experience, which is much more simplified than a traditional bank. I think you got the best of two combinations that will get people to move in a massive way to people of like Robinhood. And that's a challenge because banks have not evolved from their traditional way of revenue stream, because their cost of operation is so high, they have to charge the customer. But they have to internalize that revenue stream from their own investment and management of their investments.
Now, presumably, hedge funds would claim that they can, because of their increased sophistication, they would claim they can outperform the Robin Hood traders. And if they couldn't, there'd be a problem, right? Because these Robin Hood traders don't have any particular training or experience. And so you would expect that the hedge funds, with their artificial intelligence systems and so on, would be outperforming the traders. So how do you see the dynamic, the balance playing out between the services offered by a hedge fund and then the services offered by a retail bank to a Robin Hood trader?
Well, I think Robinhood trader will not be able to give this kind of commitment if they are going to trade like a hedge fund, very manual, right? I think the hedge fund has a certain level of limitation in terms of the scope and depth that they go into the trade market, right? Whereas I have seen even in FX trade where artificial intelligence will do matchings, AI will do matchings on different combinations of currencies, and will be able to give almost zero spread to the customer, but they will be able to make by processing that particular buy and sell. That means if I'm buying in US dollar and selling off in ringgit, you will see that pair at the customer level, but you most probably the AI actually at the back will run maybe 20 or 30 different pairs to optimize the spread and to make sure that at the end of the 20 or 30 pair trades that you still go back to minimal spread to the customer. So if you do not have a tool like that, of course, you won't be as good as the hedge fund. But hedge fund, if they don't have a tool like that, they will not be able to maximize. It's because it's all about speed and precision. So you need that AI to drive that speed and precision so that you still can get back to the customer within the same time frame as a hedge fund would do.
Well, so I'd like to drill down more on the idea of what AI can do in the trading space. But before I do, I would just like to loop Jayant in and just ask you, from your perspective, Jayant, what do you see as the big shifts in banking and finance today, and how AI would relate to those? What would be the big challenge call-outs that you would see?
Hi, James. I think the biggest challenge we are facing in the fintech industry in Indonesia is more towards the outreach towards the unbankable population. So when we talk about AI, we mostly focused on topics such as how can we provide small credit loans or microfinances to the unbankable population who has no past histories of credit, who has no access to banking infrastructures, and how could we provide this group or sector of people a new access to economy to better their profits as well. So when we talk about AI, it's kind of in a huge range, right? It can go from customer experience to the banking industry. But how does it impact customers' life directly? According to me, the most impactful way is using AI to kind of find a way for psychological credibility for farmers and those who are still unbanked to have access to microcredits.
Mm-hmm. Yeah, so it's interesting that you too see reaching the unbanked as the most important issue in banking. And then you bring up the concept of microfinance. And I presume that in a world where we have negative interest rates, the idea of extending credit to the underbanked seems tremendously attractive for all concerned. So there are the people with entrepreneurial ideas who want to create investments in their communities and regions and in their personal life to grow their wealth on the one hand. And then on the other hand, you've got investors with trillions of dollars literally to lend who now have a new market for that money. And a market that is likely to give them a greater return, certainly than the very low interest rates that we've seen in the last little while. So could you take us through what you see as the dynamic between those two forces? On the one hand, the lenders, global lenders with lots of cash to extend, and then the microfinance recipients and what they might do with that money and how it might change their lives.
Right. When we talk about the recipients of microfinances, those who are unbankable, their psychology and their perception towards the economy is very different. It's always based on trust, one-on-one trust. They always hope for this representative who they can speak to all the time when talking about finance. How much do they owe and how much money are they going to receive? They would like this one-on-one personal communication, which is still kind of hard for the banks to reach out in the rural areas of Indonesia. When we talk about Indonesia as a country itself, a very huge base of agriculture and culture. And this is where we notice that in the rural areas, it's kind of hard for even the villagers to trust a bank. Getting credit is another option, but having the trust with the financial institution is a very strong factor that actually affects them. So when we talk about how the fintech industry and how AI can actually help all this is by enabling a new trust factor. Earlier, you mentioned about how millennials are changing their factor, how they're changing their perception towards investments, towards finances. It's actually affecting the millennials in the villages and in the rural areas as well. They're actually the ones pushing the farmers, pushing the villagers to get access to banks, to get access to financial institutions. And when we did a study with one of the banks here in Indonesia, we found out that in the rural areas, it actually can affect a lot if you have an agent or if you build trust with one of the community leaders. And using AI to map out the kind of transaction locations where a bank can notice the growth, we can actually detect and give a heads up on which locations can actually benefit um, the consumers even more.
Mhm. So just sort of stepping back, we've got this picture where we've got lenders with plenty of money to lend. We've got hedge funds that are able to generate returns. And now we've got the underbanked who suddenly have access to microfinance. So let me put a hypothetical to you, Dr. Sekar, which is this. If it's true, and we'll go into later whether this is true, we'll explore whether or not, or to what extent this can be substantiated. But let's assume that we've got a quant-traded hedge fund that's driven by AI, that's producing returns of 30%, and that we give access to, through the Robinhood trading system, to this style of hedge fund. And then we're able to extend credit to microfinance recipients for, 5%. Does this mean in theory that anyone in the world can now open a microfinance account, open a trading account, invest it in a hedge fund, and now generate 30% returns on that money with as much leverage as they choose? What do you think of that picture?
Well, I think that's a strong possibility. And because one of the, as I said, millennials are looking at profitability. They actually don't need to know how hedge fund works. They only are going to see the 30% return, right? And microfinancing is only going to look at cheap cost of financing. And also maybe they will even reinvest into the hedge fund kind of investments again. So I think this is where wealth management has come to a level of wealth creation, and it has obviously come down from the level of only accessible to people with private bankers. Now it has come to the middle and lower income. Middle income to wealth management. Now it's going down to the lower income as wealth creation as well. And accessibility is much more simpler. It is not even going through relationship managers. So it is, as long as you have $1 to invest, you have accessible to wealth creation. That's where the world has gone in, and AI is driving, like what Jayant was saying, understanding the customer's needs better, understanding the customer's ability to borrow or to lend, or and to even to invest, and this is where AI is used a lot for hyper personalization. So I don't have a standard types of product. I can actually have very much product designed to different customers. If I have 1 million customers, I could even have 1 million types of product without having to worry about how the product is traded in the market, because AI does it for you. I don't have to worry about hedge fund managing different portfolio models or anything like that.
Mm. So let's take up the issue of returns. Now, from my experience, I see there's 3 different groups of fund or wealth fund that I see in the market, and they're pursuing 3 different strategies. The first I call the alpha strategy, where they assume that they can beat the market, and they're doing it with smart guys, hedge fund managers who are poring over numbers in traditional ways and predicting the market 1 month, 6 months, 12 months into the future. Those guys haven't done very well in the last, if you look at the last 5 years. And in fact, they've been outperformed by what we'll call the next strategy, which is the beta strategy, which is simply investing in indexes and trying to keep your costs down. Now, all the big funds, Goldman Sachs and so on, have tended toward the beta strategy rather than the alpha strategy. And the alpha strategy funds have been losing clients at a rate of knots. As a result of this, they've been moving to the passive funds. But there is a third group that I'd like to call out, which I call this the Omega strategy. And these are the guys, the quant funds, that are using artificial intelligence to place their trades. And if you have a look at the levels of return for the three different groups, you'll find the alpha 3% returns, the passives sitting at 6-8% returns. But then when you look at the Omega strategy, those guys are getting 30%, 50% year on year. And the big mystery to me is, why isn't everybody doing this? It seems a very small percentage of funds have taken this route. They're all still stuck in the alpha and beta strategies. Why is this?
Well, I think the one thing the quant strategists, what they have actually understood is they have understood the market in the same way as the hedge fund fellas, right? The difference is the hedge fund guys have a longer term investment strategy. When I say longer term, it's not in years, but it's longer than the quant strategies. The reason why they have slightly longer, they could have it in a week or 2 weeks or even 1 day, 2 days. The reason why they have to do is because they can't consume and analyze data as fast as the quant traders who are using AI to do it, right? So you are able to create 20% or 30% returns with the quant guys because they are able to analyze data and look at the potential and in a much more faster, quick way, even while the market is active. And they will be able to take profits in much more shorter term, and accumulated, they're able to give you 20-30% return. Whereas the traditional hedge fund are dependent on news, and then they have to analyze it, and that consumes a lot of time. So by the time they go back to the market has changed. The landscape of the market changes almost every minute, right? So if you're not fast enough, your returns will be based on the speed that you can actually study the market. Whereas a person with AI studies it in a faster way and takes profit in a quicker way and accumulates a larger return over time.
Perhaps I could add more into it. Actually, if you notice the trend, right, there's a lot of millennials who are studying data science during their whole university program. And during the early stages of data science, you do learn how to, read the news websites, how to scrape them, how to analyze, how to predict a lot of things that might happen in the future. You could see bots predicting what will happen based on Corona affecting the economy. And these are the same millennials who are developing bots and AI to kind of predict whether the stocks will go up or down. And given the access of freedom to the different banking infrastructure, I think there's a lot more people who are trying to use their wits and to predict and to do trading, as opposed to the conventional kind of studying the market as well as studying the concept theoretically. When we talk about millennials, I think Dr. Sekar mentioned earlier that they would like high return on the investments kind of quickly, because these are impulsive buyers, these are impulsive investors, and they would like short-term gains and as much as they want. So I think in this whole economic fluctuations, if you see many of the online code repositories, you could see more and more bots being created by the minute of people trying to use AI to solve the conventional stock market investments.
Mm-hmm. So thanks for that comment, Jayant. And could I just extend on your idea a little and say, if it's true that millennials are more familiar with technology and AI in general, and they're the ones who are adopting it more quickly and applying it more intensely to the question of trading, does that mean there's a potential that they could succeed faster than the existing large institutional hedge funds? And just to put some statistics around this, currently the win-loss rate for your typical Robinhood account is about 75% of those trading accounts lose money, and it's only the balance that make money. But then this could potentially just be part of their learning cycle, because where any AI system needs to train for a while before it becomes successful. So I just wonder if you see that there's a potential that the millennials with their AI systems might overtake the large institutional hedge funds. What do you think of that as a proposition?
Right, I think Dr. Sekar mentioned earlier about how hedge funds kind of invest thinking about the long term, 5-10 years from now, and how the funds will grow. Whereas the millennial investors are thinking more on short term, a week, trying to earn enough to buy themselves a kind of a bonus or to buy a new motorbike. So I think the intentions and the volume at which they transact is a bit different. Talking about the Robinhood trading, from what the data we have seen is that the volume of transactions they do is quite much significantly lesser than the hedge fund managers. So I don't think so. It's a question of whether one can replace the other or one will succeed. But I think on how the integration process might actually lead to a more significant and stable stock market growth over the year. When we talk about banking in the 3.0 timeline, it was where the banks and the fintechs were growing in two different directions, trying to capture different segments of the consumer. But now, as we go more in time and we see how the fintech is actually empowering the banks, I think it's not a question of replacing, but how we could leverage the new technology to actually build more reliable investment platforms.
Okay. Have you been involved in the creation of these AI trading accounts yourself? Or are you aware of the kinds of techniques, the kind of AI that's being deployed?
Yeah, so it's kind of like micro entrepreneurship in our company itself. A few of our employees do invest in stocks, I would say like Robinhood trading, and they have been able to create their own bots during the spare time to actually do investments. It yields only up to like 10 to 15% profit, but the kind of frequency at which they buy and sell is more like daily or weekly for short-term growth. So that's kind of the difference where I see it.
Yeah, okay. So you've mentioned the trade-off between long-term thinking and short-term thinking. When I look at returns, I want the highest return. I don't care if it's, I don't distinguish between long and short. I just say, here's my investment horizon. I want the maximum return over that horizon. Now, there are some funds that, even though they're using quantitative strategies, they do trade in the long term. If you look at the Medallion Fund, Renaissance, if you look at Bridgewater Associates, if you look at Soros's fund, these are all very high generating funds, and they take a long-term perspective. So I don't think that to say you're taking a long-term view means you have to give up high returns or the use of AI and quant strategies. What do you think?
Right, absolutely. So going back to the question of how AI can actually empower stock trading and investment when we talk about wealth management, right? We have worked with a few investment companies as well in Indonesia, where we have actually provided a recommendation engine and kind of an AI microservice for them to actually compare the predictions we made and the predictions they made and try to kind of re-infuse that into the decision making. So there's not 100% right answer here. It's more like how we could leverage what we have built and what we can build into make it generate higher returns.
Yeah, okay. So just returning to you, Dr. Sekar, I understand you're the head technology guy there at Malaysia's largest fund. And so what would you say are the plans for using artificial intelligence within your fund? And if that's a commercial in confidence question, maybe you could just adjust the question to talk about funds generally in Indonesia that are similar to the one that you work for. And explain at a level of technological detail what AI you'd be planning to use, what the algorithms are, how they work, whatever you'd like to share in that direction.
So I don't think so I could go into the detailed technology, but I will tell you what the trend is. There are at least about 4 players or non-banks who have started to go into the market not only not local market, but even into the US market by investing in ETFs and now expanding that into money market funds, because there is a need for the younger generations and millennials to do wealth creation. So what are they looking at is a safe invest. That means a safe return, better than your traditional fixed deposit, cash deposit kind of thing, right? And stock market is something that they believe that they have to. These are the things that they believe. They believe to invest in the stock market or equity market, you need to have a lot of funds to actually make real money. And the other part is, here they could even start with an investment of as low as $1 or $100 or $10, and they will see the same percentage interest. The second part is at a very low fee. So they are going to investment into ETFs rather than individual stocks, so that they don't have to pay a lot of exchange-related fee, but they pay a very minimal management fee. And these asset managements are driven by AI-driven robo-advisory, right? And it based on the risk profiling and the duration and the intent of the investment. Then the AI will have a certain level of model portfolios, which will have a combination of different ETFs to give that particular customer the sort of safe and guaranteed return. But unfortunately, we are not supposed to use the word guaranteed.
No, of course, that's a dangerous
in the
word
banking industry, right? So, but it's a better sort of projected return, which is better than your cash deposit. So this is what's happening, and people still get the feeling that they have gone into the equity market, and ETF seems to be the easiest onboarding channel for customers to go there without having to worry. I just deposit money and then I know I'm investing in ETF, but I don't care how it's being done, but I only know my profits are being secured. It has a threshold, or it has a cut loss threshold, and I don't lose everything. So at least to a certain level, my capital is guaranteed. So that gives a lot of confidence for people to move into the market. So if you really look at it, AI is actually helping financial institutions to sell profitability in a sort of a guaranteed way.
Okay. So there's been, let me point to 3 financial shocks that the system has had. We had the tech crash in 2000. We had the GFC in 2008. And now in 2020, we've got COVID. Now, in the first 2 circumstances, we saw massive drops in every exchange all around the world. We had the same with the GFC. In 2020, we saw a little bump, but we certainly haven't had a crash. And so what's your opinion on this? And it's a kind of a 2-pronged question here. The first is it true that the shock has been absorbed and that there is no crash coming, and which of course makes ETFs a safe place to invest? So that's sort of the first part of the question. And then the second part of the question is, how would AI help us make that determination?
Right. I think the crash is always going to happen. If it's not tech, if it's not healthcare, it's going to be something else. It can be even a nuclear threat, and everything will have. The good thing about ETFs and portfolio that you have a softer lending, because you avoid concentration risk. Your risk is spread into multiple industries or multiple focus areas. So the impact of a crash in the market is not going to be throughout the whole market. It will only be certain industry related, especially in COVID, right? You will see airline companies going down, you will see travel companies going down, but you will see healthcare going up, right? And what this will do is, the AI has the ability to actually have this to do portfolio rebalancing for the customer, and then it changes the investment model without the customer having to ask for that rebalancing, right? And because it's ETFs, it's easier to do that. And And with that, you sort of can cushion the impact of that crisis with to a minimal level, that it doesn't eat up on your profitability or your capital, because that rebalancing in a traditional manner happens over a few days, whereas in an AI-driven technology, it can happen dynamically, right? So it is again speed, data, and predictive, all at maybe time tested, and also with that AI driven, and of course machine learning is going to help us understand new threats, new crisis management, and build it into the AI algorithm as well.
Mhm. Yeah, that's right. There's and probably now's the time to call out a few differences in the types of AI that are available to make this kind of determination. Some AI systems only look at what they call training data, and they assume that the future will be like the past. And so the way it operates is it says, here's a set of predictive indicators. Let's look back through our training set to find where those predictive indicators have popped up before. And then whatever happened in the past, we'll assume that that's going to happen again in the future. Now, most machine learning systems, AI systems, operate this way. But there's a new generation of AI systems which outperforms this technique. And the new generation is called Causal Science. And it doesn't rely on the future being like the past. It doesn't make that assumption. And so heading into questions that are highly ambiguous, like the question of whether there'll be a future stop crash, is much better handled by Causal Science.
Yes.
So can I just do a time check with you there, Bhavana?
Yes, James, so we're running out of time. If it's okay, James, question from the audience. Could we take that up?
Absolutely. Could you just read it for me, please? And
I'll do that. So Atika is asking that, we've seen a huge decline in the trade stock market during the pandemic outbreak. Thus, making predictions based on trends alone is not sufficient. How can we make AI predictions more robust to take into factors that affect the trade stock market? What's your view there?
yes. Okay, so the way we do this is we use a powerful AI technique called Causal Science. What Causal Science does is it understands why things happen. And because of this, it can predict the future in a way that's not dependent on the past. Now, my favorite example of this is when Neil Armstrong flew to the moon, and he did an experiment. And the experiment was he dropped a hammer and a feather on the moon. And he said that Newton's theories are going to predict that both of these things will hit the ground at the same time. And he did this in front of the camera, and sure enough, the hammer and the feather both hit the moon's surface at exactly the same time. Now, this was an exciting result because what we were seeing was a prediction that was made on the basis of a causal rule, a causal law, in this case, the law of physics. Interestingly, this prediction was not made on the basis of having seen it before. There was no training data set in the world where dropping a hammer and a feather at the same time resulted in both objects hitting the surface at the same time. And so this is, I think, is a strong conceptual demonstration of the power of causal science. And so, how do we escape the assumption that all trends continue, which of course we know they don't? The short answer is to use causal science instead of things like deep learning or regression, random forest. All these techniques make the assumption that the future will be like the past. If the questioner would like to take this topic up with me afterwards in more detail, I'd be very happy to do that.
Sure. So thank you so much, James. While we're a little short of time, if you could just give in any concluding statement before we wrap up.
Okay, well, I'll ask my panelists first to provide concluding statements. So, Dr. Sekar.
Well, I think what I want to say is AI is already in the space of robo-advisory, so also in algo trading or quant trading. It's also managing Forex and everything. And I would see these trends picking up and actually create better efficiency in customer engagement and wealth management. And I believe that customer needs to be better managed with product through hyper-personalization. And this trend, I don't think so it's going to stop, but it's going to be more optimized, and that's going to be a big challenge for traditional bankers who don't evolve into understanding. And of course, like what Jayant said, hedge funds will still be there because they take care of large institutional customers, but this is the retail that's going to change and the landscape of the financial industry in the future.
Absolutely. And I think I would like to conclude by saying that,
Yes.
AI has made a lot of changes in terms of customer experience, the fact how we supply credit to SMEs as well as those who are unbanked, as well as explore different kind of conceptions in which AI has been giving advice to robo-advisory. But I think this is just the start of where machine learning has been able to recommend us with different solutions, and I think that this will be the next step forward.
Thank you. Yeah, and I guess my concluding remarks would be, there we go. All right, I think we're done. Good.
James, you can continue on your side, please.
Oh, okay. Oh, we got time? Yeah, for a concluding comment. So the concluding comment would be, I think it's already evident in the market that the investors that are using AI are outperforming the investors who are not using AI by 3 to 1 or more. That only investors who are using AI will succeed in future. The take-up rate seems to be greater amongst the millennials, amongst the Robinhood traders, amongst the new entrants to the market. And my advice to the large institutions would be, don't be left behind. Catch up, use more AI, get your returns from 5% where they are now up to 30% where they should be. That would be my concluding comment.
Thank you so much, James, Dr. Sekar, and Jayant. What an incredible panel discussion this has been. Once again, a big, big thank you.